For years, Country Garden was the pride of China's property boom, transforming hundreds of cities and generating over $70 billion in annual revenue. A family dynasty stood at its helm, and the company became a symbol of rapid urban growth. Now, with $205 billion in debt and buyers desperate for their homes, the company once considered too safe to fail faces unraveling. How did China's most trusted developer reach the edge of collapse? What does this disaster reveal about the future of an entire nation's economy? Country Garden's rise began quietly in the early 1990s when Yang Guoqiang, the son of a poor farmer from Guangdong, started building modest homes on the outskirts of Foshan. By the late 2010s, his company had transformed into the largest property developer in China by sales. Between 2017 and 2019, Country Garden topped national rankings, reporting contracted sales that eclipsed industry giants and landing the company on the Fortune Global 500. At its peak, annual revenue soared past $70 billion, a figure that rivaled the output of entire nations. The scale was staggering. Country Garden was active in over 200 cities, from sprawling provincial capitals to county-level towns that barely registered on international maps. In those places, the company did not just build apartment blocks, it created entire new districts, with schools, shopping malls, parks, and hospitals all woven into master-planned communities. The ambition was to deliver the promise of urban life to millions who had never known it before. Yang Guoqiang's story became a symbol of China's new era. After the company's 2007 Hong Kong initial public offering, he handed a major stake to his daughter Yang Huyan, who would soon become Asia's richest woman. Their family name became synonymous with opportunity and upward mobility, a rags-to-riches saga celebrated in business magazines and government speeches alike. Country Garden's brand was built on reliability and scale, with mass-market homes rather than luxury towers, and partnerships with local officials rather than celebrity endorsements. For years, the firm was considered the gold standard, the developer families trusted with their future, and even cautious investors believed it was simply too solid to stumble. Country Garden's balance sheet tells a story of breathtaking scale and fragility. At its height, the company owed roughly $205 billion in total liabilities. This mountain of obligations was not just traditional bank loans or bonds. About a quarter sat as bank and other loans, another slice as domestic bonds, and a significant share, nearly a third, was money owed to suppliers, contractors, and local governments. But the largest single block was contract liabilities, cash collected from home buyers for apartments that had not yet been delivered. These pre-sale obligations, at times reaching $80 or $90 billion, meant ordinary families were some of the company's biggest creditors. The engine driving this machine was China's pre-sale system. Developers like Country Garden sold homes before a single brick was laid, collecting large deposits or even full payments up front. For years, this provided 70 to 90% of the cash needed for construction. As long as new buyers kept coming, the cycle spun forward. Pre-sales funded building, which funded more land, which brought in more pre-sales. But this loop depended entirely on constant rising sales. The engine depended on momentum. When the property market cooled, the model's weakness became clear. In August 2023, Country Garden missed its first offshore bond coupon payment, a $15 million obligation. That single missed payment triggered cross-default clauses, allowing creditors across multiple bond series to demand immediate repayment. Ratings agencies quickly downgraded the company, and panic spread among investors. Without fresh pre-sale cash, the company's liquidity crisis became undeniable. Country Garden could no longer meet its immediate obligations, leaving suppliers, workers, and home buyers at risk. Reports described frozen payments to contractors and staff, stalled construction sites, and families waiting on apartments they had already paid for. This was not just corporate stress, it was a social crisis. In August 2020, Chinese regulators introduced a new set of rules for property developers, 3 hard limits known as the 3 red lines. These were not just guidelines, but strict thresholds. A liability to asset ratio, excluding advance receipts capped at 70%, net gearing no higher than 100%, and a cash to short-term debt ratio of at least 1. For Country Garden, which had built its empire on easy access to credit and a constant flow of pre-sale funds, The new framework changed everything overnight. Red lines. At first, Country Garden's balance sheet looked strong enough to comply, but the policy was designed to halt the relentless borrowing that powered China's housing boom. Even developers who met all three limits could only grow their debt by a maximum of 15% each year. For firms edging close to the thresholds, the cap tightened to 10%, then 5%, and finally 0 for those who breached all three. As sales began to fall after 2021, these rules acted like a clamp on the company's ability to refinance maturing loans or raise cash for new projects. Clamp refinance. The effect was immediate and severe. Banks pulled back, wary of lending to private developers, especially as government guidance shifted support toward state-owned firms. Bond markets, already jittery from earlier defaults in the sector, became nearly inaccessible. Country Garden found itself unable to roll over old debt or secure new funding at scale. Land that once looked like a long-term asset became a liability, impossible to sell quickly without deep losses. Pre-sale cash, once a reliable lifeline, dried up as buyers hesitated or disappeared altogether. Immediate lifeline. The three red lines did not just slow Country Garden's growth, they froze its cash pipeline. Obligations to suppliers, workers, and home buyers kept piling up, but the company's traditional sources of liquidity had all but vanished. What began as a regulatory effort to rein in risk had, in practice, turned a balance sheet challenge into a full-blown cash crisis. Froze crisis. Rows of silent towers stretch across the outskirts of Pingdingshan, Henan, concrete shells that were supposed to be homes for thousands of families. In Country Garden's Phoenix City project, buyers handed over life savings and signed mortgage contracts only to watch construction grind to a halt. By late 2022, local authorities added the site to a public list of stalled developments, and residents organized online, drafting boycott letters and threatening to stop mortgage payments until work resumed. In Xiangtan, Hunan, the story repeats, with overgrown lots and shuttered sales offices at the Yueshanfu compound, and families already making monthly payments for apartments they cannot move into. Social media groups fill with anxious messages about missed deadlines and broken promises. For many, these apartments are more than investments. In China, home ownership anchors marriage prospects, family security, and social standing. Parents and grandparents often pool decades of savings to help a young couple buy a first home. When construction stops, it is not just a financial setback. It is a blow to a family's future. Mortgage boycotts, once unthinkable, spread from city to city through 2022 and 2023, with buyers from dozens of Country Garden projects joining open letters and protests. In some developments, hundreds of households coordinated payment suspensions, demanding either completion or refunds. Contractors feel the shock too. A site foreman in Guangxi describes months without pay, watching his crew dwindle as bills pile up. Small construction firms dependent on timely payments from Country Garden face bankruptcy as arrears stretch on. Across the country, the ripple effect is unmistakable. Unfinished homes, unpaid wages, and a spreading sense that the old promises no longer hold. Trust, once the bedrock of the pre-sale model, cracks under the weight of empty buildings and unanswered calls. China's population reached its peak around 2021 or 2022, according to official statistics, and has now begun to shrink. This turning point casts a long shadow over the property market. Fewer young adults are forming new households, and the pool of first-time homebuyers is shrinking every year. The National Bureau of Statistics shows youth unemployment above 20% in 2023, with many young people struggling to find steady work. As a result, more are delaying marriage, putting off home purchases, or abandoning the traditional path of buying an apartment before starting a family. Meanwhile, years of rapid building have left the country with vacant units, especially in smaller cities where Country Garden concentrated its efforts. Studies estimate tens of millions of empty homes nationwide, far more than new families can absorb in the coming years. High household debt and slower wage growth add to the strain, making it harder for buyers to take on new mortgages. The old expectation that every new generation would buy a home no longer holds, leaving developers with projects few can afford or want. Two paths now define China's property reckoning: a controlled restructuring or a chaotic collapse. In a managed scenario, courts approve sweeping debt deals, offshore bondholders accept deep losses, and state-backed firms step in to finish homes. Here, homebuyers may eventually receive keys, though often after years of delays and cut corners. Offshore creditors, facing long waits and heavy losses, recover only a fraction of what they are owed. If the process unravels, multiple developers could default at once and overwhelm local governments. Projects are abandoned, mortgage protests spread, and the financial system absorbs fresh shocks. The property sector's weight is unmistakable. Real estate and related industries make up roughly a quarter to nearly a third of China's entire GDP, and that scale turns corporate failures into national problems. At full tilt, a builder like Country Garden could consume over 1 million tons of steel and up to 10 million tons of cement in a single year. When construction halts, that demand vanishes, rippling out to global suppliers and commodity exporters. Signals to watch are offshore bond payment deadlines, the pace of court-sanctioned restructurings, new government rescue packages, and monthly sales updates. Offshore bond payment deadlines, pace of court-sanctioned restructurings, new government rescue packages, monthly sales updates. For homebuyers, the true test is whether stalled projects see real progress, not just promises. For investors, the fate of China's property giants will shape global markets for years to come. Today, millions in China still wait for homes that may never come, while $200 billion hangs over the global economy. Country Garden's unraveling isn't just a corporate crisis, it is a warning that unchecked growth carries consequences no policy can fully contain. What future will be built now?